Key warning signs you must notice before entering a trade. The chart is open in front of you. The price is hovering near a zone you marked earlier. Everything looks tempting. Candles are speeding up. The market feels like it's about to move, and your mind keeps repeating one line: if I don't get in now, I'll miss it. That moment is one of the most dangerous times to make a decision. Very often, before a trader hits the buy or sell button, there are several clear warning signs that the trade does not have the quality it should. But because the mind is locked on the opportunity, it simply doesn't see them. So what's the result? A rushed entry, a bad stop loss, an emotional exit, and that familiar sentence: I shouldn't have taken this trade in the first place. In this video, we're going to look at a few key signs you should take seriously before you enter, because sometimes the best trade is the one you decide not to take. Part 1. When your reason for entering is not clear. The first warning sign is when you can't explain in one simple sentence why you want to take the trade. If someone asks, "Why are you buying here?" and your answer is, "I just feel like it's going up," the setup is not complete yet. A good entry needs specific reasons: the zone, the structure, the confirmation, the stop loss, and the exit scenario. For example, the price has returned to support, shown a reaction, short-term structure has shifted, and a logical stop sits below the previous low. When your reason for entry is clear, even if the trade loses, you can review it later. But when the entry is driven by a feeling, there's nothing concrete to analyze afterwards. It's just a vague decision that either happened to work or happened to fail. Part 2. When you don't have a logical stop loss. The second sign is when your stop loss level isn't defined before you enter. Many traders jump into a position first and then only start looking for a place to put the stop. That means the trade was incomplete from the beginning. You need to decide your stop before you enter, because position size, risk, and even whether the trade is worth taking at all depends on it. If the stop is too tight and can be hit by a normal volatility, the trade is fragile. If the stop is too far and ruins the risk the reward, maybe the trade is not worth taking at all. A good entry is one where if the price hits your stop, it truly weakens your idea, not one where a random wick is enough to kick you out. Part 3. When you're entering only from a fear of missing out. One of the most dangerous signals is pure urgency. Price has started to move, candles are getting bigger, and you feel that if you don't get in right now, the opportunity is gone. This state often makes you enter late, right after the best part of the move has already happened. Then the market makes a normal pullback and you exit at a loss or in fear. Fear of missing out almost always lowers the quality of analysis. Instead of asking, "Is this entry in line with my plan?" you ask, "What if it goes without me?" That second question is the start of many bad trades. If it really is a solid opportunity, the market will usually offer a more logical entry point, and if it doesn't, you're not supposed to catch every single move anyways. Part 4. When the market is out of sync with your time frame. Sometimes the analysis is done on a higher time frame, but the actual entry is taken emotionally on a lower one. For example, on the 4-hour chart, there's no clear structure yet, but on the 5-minute chart, you see a sharp move and jump in. A few minutes later, you realize that the move was just noise inside a bigger range. Before entering, you need to know which time frame is driving your main decision. If you are swing trading, a random 5-minute spike should not flip your bias. If you're scalping, you can't rely on a general daily bias without a precise entry trigger. Time frame alignment means direction, zone, and entry trigger do not contradict each other. Without that alignment, the trade becomes confusing very quickly. Part 5. When market conditions don't match your strategy. Every strategy is built for a certain type of market. A breakout strategy can fail over and over in a choppy range. A mean reversion or reversal strategy can get run over and over again in a strong trend. Before entering, ask, "Is the current market suitable for my style?" If your strategy is trend-based but the market is tight, slow, and directionless, waiting is often better. If you hunt reversals at support and resistance but the price is trending hard in one direction, Fading that move can be dangerous. Many traders try to force their setup onto any market they see, but often the market is clearly saying, right now isn't the right market for that strategy. Part 6. Summary. Before you enter a trade, there are always a few signs that can tell you a lot about its quality. If your reason for entry is not clear, if you don't have a logical stop, if you're acting out of fear of missing out, if your time frames are out of sync, or if the market conditions don't match your strategy, it's a good moment to pause. A professional trader focuses on two things: finding good opportunities and filtering out low-quality trades. Sometimes what separates growth from going sideways isn't the trades you take, but the trades you consciously choose not to take. So before you enter, take a few seconds and ask, is this really according to my plan, or am I just reacting to the price movement? If this idea was useful for you, then next time before you enter a trade, pause for a few seconds and quickly review these 5 points: your reason for entry, your stop loss level, any feeling of urgency, time frame alignment, and whether the market suits your strategy. That short pause alone can often stop an emotional trade. Now tell us in the comments before you enter, which warning sign do you ignore most often: unclear stop loss, rushing in, or mismatched time frames?